Rental properties are a great investment, right? Well, not always. Stick around while I share some common mistakes that will avoid you from draining your bank account when it comes to buying an investment property. If you want to learn more about real estate investment and everything in between, like and subscribe to my channel as I will be putting out weekly content. So stick with me, let's go. Investment properties can be a great way to build financial wealth. If you choose the wrong property, it can quickly become a financial disaster. In a recent study, about 25% of new landlords underestimated the maintenance costs of a home, and 15% dealt with long vacancies that ate into their profit and ultimately ended up with them selling the property. Many investors jump into their first rental property because, well, we're excited. We want to get the ball rolling. We want to implement. We're super excited to get our first cash flowing property so we can get rolling and get the second one. We almost become like starstruck. It's like when you meet a celebrity, you just don't know what to say. You're not sure of the words that are coming out of your mouth. It's the same when you're analyzing and looking at a first rental property. We don't think about location, market trends, property location. We kind of just get a little bit foggy and we don't really focus in on the data, on the details that really need to be analyzed when buying an investment property. But you really need to focus on, well, one is location. You need to know that the property's in a great location and hopefully an up and coming community that will also increase the appreciation of the property over time. We also need to look at market trends so we know when the right time to buy the home. And of course, the condition of the property. A lot of people get caught up in, well, I can just fix that, I can do that. But is that going to affect your bottom line? You need to make sure that the home is going to be profitable, not only in the short term when you take possession, but also in the long term, and that it's building a little bit of a nest egg. So if there is an issue, you do have a vacancy, that there's that nest egg that you can pull from and you don't start to lose money on the property. Did you know that about 35% of Canadians report having issues with tenants, leading to costly evictions? Buying an investment property in a solid community is going to ensure that you're getting quality renters. It's also really important to understand what is the rental costs in that neighborhood. That's going to help you put together your spreadsheet and have an understanding of, does this property cash flow? But before we go any further, I got a simple question to ask you, and I want you to put it in the comments below. Would you rather have an investment property that yields a return of 5% with little to no stress, or 10% and it's an absolute disaster? The answer is obvious, right? Well, I'm going to show you some simple strategies to avoid stressful investments and keep a healthy return on your investment. So we'll circle back to the conversation around location. Some of the things you want to consider when you're looking at location to buy an investment property is proximity to good schools. Do the schools have a good reputation? Is there a large enrollment rate? You want to make sure that you're in an area that has solid schools, because this is going to attract families that ultimately want to rent your property. Another thing to look at in a community is a strong job market. What's the unemployment rate in the area? You want to buy an investment property in an area that has a very low unemployment rate, because obviously if people are working, they can afford to pay the rent. And the last one is crime rate. You want to find communities that have a low crime rate, because this is going to attract better tenants that are more likely to pay, and also avoid the risk of your home getting vandalized or other issues that might arise from a high crime rate area. Another thing to consider is market trend. We need to look at, well, first off, what is a property renting for in the area you're considering? Go on Facebook Marketplace. Have a look at rentals in that area and see what they're going for. Now be careful, don't get caught with this. Just because someone's selling an old Mustang for $15,000 doesn't mean it's worth it. So if you're seeing all those ads for the rentals, there's a chance that maybe those are the overpriced ones that nobody's actually renting. So grab 10, 15, or even 20 of them and then take the average of that, and that should give you a good idea of what the rental market looks like in that area. If you see that it's saturated with like 300 ads for rental properties, you might want to consider looking at another area, because obviously that means that the competition is really big for that area and you might have a hard time renting the property, leading to vacancies throughout the year. I've shared on some of my other videos about the trend as far as, what real estate does. It kind of goes like this and it goes like this, but it just keeps going up. So when you're looking at a property, it is good to look at, well, I see some appreciation, but also remember that when you're buying an investment or a rental property, this is a long-term investment. So you don't need to get super hung up on the appreciation appreciation, as long as the property cash flows and it's making you money every month, eventually it is going to appreciate. Really just focus on finding the right neighborhood. Now, something that I look for when I'm looking for a rental property, I want to look at neighborhoods and communities that have development potential. Because in 5, 10, 15 years, when I've cash flowed that property, I've made a bunch of money off of it, and the mortgage is now reduced substantially, it might be a great time to either develop the property myself or sell it to an investor for a bit of an inflated cost. So most neighborhoods and communities have what they call an official community plan, or OCP. So when you're looking at rental properties in different communities, go on that local municipality or city's website and search for their OCP and look at the zoning map and see what that prospective property is zoned for, because there might be potential to develop it down the road, or like I said, sell it to a developer and cash in on that sweet equity. Now, this may seem like an obvious one, but it's often overlooked by so many people, and that's the condition of the property. You want to make sure that you get an inspection. Now, I'm a journeyman carpenter by trade, and trust me, it's hard for me not to be like, oh, I'll just do the inspection myself, But these guys are professionals. They do it every single day. They're looking at tons of properties. Get an inspection, get 2 inspections. Just get some eyes on the property and figure out what your costs are going to be, because the last thing you want to do is buy an investment property that's making you $1,000 to $2,000 a month and it gets eaten away with a capital cost like a large roof replacement or perimeter drains or a septic system. Those things can kill your bottom line on a property investment. So make sure that you're really looking at it. Now, there is a market to buy renovation or rehab type properties, but knowing exactly what the scope of work entails and making sure that you have a budget for that is extremely important. Finally, I want to talk about a key metric called cap rate that every investor should know. Cap rate stands for capitalization rate, and it is used to measure the return on investment on a rental property. It's essentially a ratio between the net operating income and the property's market value. So what we need to calculate first is the NOI, or net operating income, the total rents minus all operating expenses. Operating expenses can include management, taxes, maintenance, just to name a few. Secondly, we want to figure out the market value, which is the current value of the home. Now, the formula is super simple and essentially looks like this. If you have an NOI of $50,000 and the property's worth $1 million, that's $50,000 divided by $1 million multiplied by 100 equals a 5% cap rate. A good rule of thumb is to aim for a 5 to 8% cap rate, but that can also depend on the market. In more high demand areas like the city of Vancouver, you might be looking at the lower end of that range, but properties with a higher cap rate tend to provide better cash flow. And now the strategy I promised earlier. Don't rely on appreciation. Many investors think that their property will go up in value and that that'll save them. That is an extremely dangerous presumption. Instead, you need to look at properties that provide positive cash flow from day one. This means your rental income better cover your mortgage, your insurance, your property taxes, maintenance, and anything else in between. So when you're looking at rental properties, do your cap rate calculation and make sure you're getting at least 5%. So the key to avoiding a bad rental property is really simple. You need to do your homework. Location, market trends, and the condition of the property. Don't just jump in because you see this shiny object and you want to own a property so you can tell all your friends that you're a real estate investor. Now, I want to hear from you guys, so please leave a comment below. I want to know, where are you at in your real estate investment journey? Have you already bought your first investment property, or is this going to be your first one? I want to hear your experiences and your stories so we can all collaborate together and help each other out. And don't forget to like, subscribe, and turn on post notifications for more great videos on how to invest in real estate and everything in between. To learn some key strategies to find an investment property, check out this video here where I explain A to Z how to find the perfect investment property.